Yo, what's going on, y'all? I hope you guys are doing well. This will hands down be one of the most informative presentations you have ever saw in your life. My name is Nick, and this is my fund mastery course where I'll talk about how these three funds, index funds, mutual funds, and ETFs, can make you a future millionaire. I have a net worth of $130,000 at the age of 26 just from investing in index funds and ETFs, stocks, and a little bit of option trading on the side. I've been invested in the stock market for about 6 years now, and this is something that I'm extremely passionate about. So grab some popcorn, put in some headphones, and let's get right into it. So here's a percentage of the things that you will learn in this course. I'll give you a deep explanation of what index funds, mutual funds, and ETFs are. We'll talk about inflation, compound interest, and the power of it, 3 methods to make millions in the stock market, how the stock market even works. I'll give you a deep explanation of the big 3 indexes. I'll go over of the history of funds and how funds were even created. I'll give you the advantages of each type of fund, explanation of what fund holdings and weightings are, the best types of mutual funds, index funds, and ETFs, explanation of sectors and industries and the best to invest in from personal experience, best brokerages to buy funds, how to properly even buy a fund, how to use a stock or a fund screener, and so much more. Make sure you guys follow me on Instagram at RealNickBryant, and make sure you stay tuned to the course that's coming soon called the Leverage God course, where I'll talk about option trading and leverage ETFs. Alright, so the last thing before we jump into the course is make sure you guys join my free public Facebook investing group and you join the Reddit forum. The Facebook group will have daily discussions, daily infographics, and daily chats. Over 6 years of investing knowledge will go into this group, and it's not just about stocks, it's about real estate, credit, life insurance, estate planning. You will also get the plays that I make in the stock market and see if you can make some money yourself. Get in this group for free right now. It's not going to be free forever, and that's all I'm going to say about that. If you are a new stock market investor, you are definitely 100% going to want to be in a group full of other investors. I am personally going to make it as easy as possible for y'all to understand how investing works. If you want the downloadable version of this presentation, join the Facebook group and it will be in the featured post. Over 2.5 gigabytes of information will be in this course. I have over 20 gigabytes of information going in the group. Make sure y'all take notes, screen record the important parts, and go back and listen to it later. This course will be time stamped and you can put it in 2x speed if you want to download the information to your brain a little bit faster. Some of the course I'll have me talking and some of the course it'll just be straight notes. I don't want y'all looking at me or my background. I want y'all to be purely focused on the presentation. Alright, so without further ado, let's jump into the course. Alright, so module 1, intro to the world of investing. I want to start off by saying nobody has ever saved their way to $1 million. They had to invest it. Unless you are a doctor, a lawyer, a rapper, etc., your job will never pay you $1 million in the time frame that you want it. Investing, hitting the lottery, or stealing it are the only 3 ways that you will ever see $1 million. It is what it is. Alright, so here's the number 1 reason you need to invest. Inflation. So let's go over a quick example of how inflation works. Alright, so here we have the price of Air Force Ones today, and we have the price of Air Force Ones in 2007. The price of Air Force Ones in 2007 was $92. The price of Air Force Ones today are $115. So if you have a $100 bill in 2007, you can afford to buy the ones. If you have that same $100 bill in 2025, you cannot afford to buy the ones. Notice the amount of money you have stays the same, but what you could purchase, your purchasing power, that dwindles. If you only save that $100 by keeping that money in your savings account, you will not be able to afford the same exact item years later down the road. But if you invested that $100 by putting money into an investment account, years later, you can buy more of the item you want or at least keep up with the price increases, giving you more purchasing power. If you do not invest that $100, years later, your $100 will be worth less, forcing you to not be able to afford it, or you have to spend more money for the same exact item. If you invested that $100, years later, it would be worth more, letting you buy the item in full and have some left over to buy more or another item. You cannot beat inflation by saving. Only investing is how you beat inflation. Alright, so here's how investment returns work. Let's say you start tomorrow and you invest $125 per week, that's $500 a month or $6,000 per year into your favorite company, and you receive back 15% interest per year for 10 years. Now this right here is an investment calculator from calculator.net. So let's plug in a starting amount of $0. After about 10 years, we have a return rate of 15%. This is going to be compounded annually, and we're going to contribute that $500 at the beginning of each month. Now, it doesn't really matter if it's the end or the beginning of each month. It'll just be a slight difference. But overall, let's plug in these numbers and see what happens. In year 10, you will end up with $130,000 from just $125 per week, right? So that's your ending balance right there. Now, what I want you to pay attention to is your contributions and your total interest. Notice the contributions. If this was in a regular savings account, saving $6,000 per year for 10 years, that's $60,000. Now, this is most likely what you've already been doing. Maybe not $6,000 per year, but you definitely save instead of invested for most of your life. Now, in this example, because you chose to invest, you have an extra $71,000 to play with. Now, let's see what happened when you do this for 20 years. We're going to keep everything the same, but we're going to just change that to 20 years. Look at the end balance, $663,000. Take a look at the contributions. You only contributed $120,000. That's 20 years times $6,000 per year. But look at the interest. The interest alone yielded you $500,000. You will end up with $663,000 from only $125 per week. Now, what happens if you sped this up by getting a higher paid job or you just put down the weed? Take a quick look at the graph though. Notice how as time went on, the green gets higher and higher. That's the power of compound interest. As you begin to make interest on larger amounts of money, your contributions don't even come close to the amount of money that the interest is giving you. We'll talk about that a little bit more in the next slide. So here's the difference if you chose to save versus invest for 30 years. If you chose to save instead of invest for 30 years, $6,000 times 30 years would give you $180,000. Now compare this to investing for 30 years. If you chose to invest for 30 years, you would have $2.99 million for you and your family. Keep in mind, this is all from $125 per week. Think about the complete lifestyle change that you and your family will have. Even if you don't do it for 30 years, look at how much you will have in 20 years. If I was 50 years old right now and I did this until I was 60, I'd be happy with a good $60,000 right here. You have to start investing today. All right, so let's talk about the power of compound interest. The longer you invest, the more deadly your account will be. Compound interest is the interest that keeps building on itself. You earn interest on your contributions and on the interest you've already earned throughout the years. Let's take a look from our previous example. Here's a graph of compound interest and here's a graph of simple interest for 20 years, both of them. So the general formula for compound interest in the stock market is ending balance from the previous year plus your yearly deposit plus interest for the current year equals your final ending balance for that current year. So let's look at an example. $6,477 is the year one ending balance plus $6,000 yearly deposit plus $1,448 in interest equals $13,925. Let's look at year two. $13,925 is your ending balance plus $6,000 yearly deposit plus $2,500 in interest equals $22,491 for your ending balance, and so on. So here are some key takeaways. If you save $6,000 a year for 5 years, you have $30,000, as you can see on this simple interest calculator. But if you invest it in 5 years, you would have $43,671. Another takeaway, it took you 9 years to crack your first $100,000, but it took you 4 years to get to your second. The reason why these numbers are getting so large is that you're essentially going from having 15% interest on $6,000 per year, which is year one, to 15% interest on $130,000, which is year 10, to 15% interest on $660,000, which is in year 20. The compounding effect exacerbates the longer time frame you go, as you keep getting the same interest rate every year, but just on larger sums of money. Look at the year 20 differences: $120,000 if you simply save versus $663,000 if you simply invested. Let's take a look at one more example of compound interest before we get deep into the topics. All right, so who's about to earn more? This example shows how the earlier a person takes advantage of compound interest, the more time that money has to grow. All right, so we have two investors. Investor one is going to be the woman right here in the blue. She starts at 25 years old. She sets aside $5,000 per year for 10 years in a row. No more investments she will make to this account after age 34. Investor two, he starts at 35. He invests $5,000 each year for 30 years in a row until reaching age 65. So look at the amount investor 2 has and look at the amount investor 1 has. So some key takeaways. Investor 1 ended up with $176,000 more than investor 2, even though she stopped investing or contributing for 31 years. She stopped investing at 34 and wanted to cash out at 65. That's 31 years she stopped investing. 787 minus 611 is $176,000 difference. Another takeaway, as time goes on, investor 2 will never be able to catch up to investor 1 unless they put in hundreds and hundreds of thousands of dollars at one time. A question for you, what if investor 1 never stopped investing? According to an investment calculator, she would have had $1.4 million, nearly double of what she had when she stopped investing and over double of what investor 2 had. As you can see, that's almost $1.4 million as an ending balance. The key highlight of this that I want y'all to pay attention to is how she stopped investing. She didn't contribute contribute any more to that investment account. This is why it's extremely important to begin investing as soon as possible, because you can never catch up to lost time. Each day after you watch this video, you are literally losing money if you do not begin investing as soon as possible. Hey, do not be like this dude right here. He said, I wish I would have started earlier. I'm 44, started seriously investing only about 8 years ago. On top of that, I found myself really wanting to, or dare I say needing to, retire early. Now desperately trying to catch up. If you're in your 20s or 30s, guys, put as much in as you can, because time catches up with you quick. Alright, so what if you don't want to wait 10, 20, 30 years to get rich? If you want to get rich faster, you will have to invest more and or take more risk. A general rule of investing: more risk equals more return. Less risk equals less return. There are 3 main ways to use the stock market to speed up this process of investing. Number 1, option trading. Option trading is you essentially making bets on whether you think a stock will go up or down by a specific date. For example, let's say Tesla stock is currently at $345. You place a bet saying you think Tesla will fall to $300 by December of this year. If Tesla stock starts heading towards $300, you make a ton of money. If you're wrong and Tesla ends up going to $400, you lost a lot of money depending on how much you put in. This is what I specialize in, because you could put in $100 and turn it into $1,000 like it's nothing. Hey, y'all remember in the beginning of this course we used 15% for those examples? This dude on Reddit is up 576% in a single year due to option trading. Options can give you some life-changing returns, but it comes with a slight learning curve. That's what my Leverage Guide course is going to be for. It's going to make it as easy as possible for y'all to understand. I got y'all ain't got to worry about that. Next, we have swing trading, which is essentially you seeing that a stock is falling, you buy shares of it, and then when it goes back up, you sell the shares you just bought for a nice profit. It's the trading in between day trading and long-term investing. You don't buy and sell within a day, nor do you hold the stock for years and years. You find a good company whose stock is just getting beat down at the moment, you buy shares, and then you sell it. It's that easy. I've made tens and tens of thousands of dollars just by swing trading the same stocks over and over again. Look how many times you can buy Tesla while it's low and sell while it's high. Last but definitely not least, we have long-term investing. Long-term investing is you buying shares of companies you believe in and holding them for years and years. This is obviously where that compound interest is going to kick in, and this is the most recommended strategy. An asset that most investors invest in is the S&P 500. It's up almost 100% in 5 years, which is a double up on your money, and it has one of the most solid track records, providing you about a 10% return each year. We'll talk about the S&P 500 later and how you can invest in it. You can also long-term invest in growth stocks. So over the last almost 5 years, Palantir is up over 500%, where $10,000 would have turned into $58,000. They have an overall return of 481% in that time frame selected right there. That is a compound annual growth rate of 52% per year. Again, compare that 15% example we used earlier to 52% right here with Palantir. The stock market will literally print you money out of thin air. The U.S. stock market is propped to go up forever. The backbone of the U.S. economy and what fuels our growth are 401ks, IRAs, and pension funds. This is where most of the wealth in America is stored. This money is then invested into the world's best companies like Apple, Microsoft, Nvidia, Google, Amazon, Meta. Those companies produce products that we use and buy on an everyday basis. That in turn fuels our economy even more. Without the stock market, we are not the world's wealthiest nation. As you can see, I asked here Google how many people have a 401k. They said, as of December 31st, 2023, about 70 million people are active participants in 401k plans, which hold $7.4 trillion in assets. Yes, other countries do in fact have their own stock markets, but they are not as strong as ours. A lot of you are probably invested in the stock market and don't even know it. I looked up on Google, what is my 401k invested in? They told me they can be invested in mutual funds, exchange traded funds, target date funds, index funds, money market funds, individual stocks and bond funds. And we'll talk about all of that in this course. When choosing investments for your 401k, you can consider your risk tolerance and time to retirement. You can check the balance of your 401k by logging into your 401k provider's website portal. You need to, at this second, send a text to your HR department or whatever you got to do and ask them how much is in your 401k if you have one with them. And if you're under 18 and you're watching this, ask your parents about their 401k. If you had a previous job and had a 401k with that job and you got fired or something, find out how much is in that 401k. Depending on how much money is in that 401k, it can be worth a lot more since the market is sitting at about all-time highs right now. All right, so who, what, when, where, and why stock market edition. First, what is the stock market? The stock market is an online marketplace where average people can sign up to buy and sell, aka trade, their shares of a company that is listed on a stock exchange. Stock just means legal ownership or a piece of a company or an asset. Think of it like a bar of gold. Somebody has a whole bar of gold for sale. That's the business. Let's say you know that gold bar, the business, will be worth much more in a couple years, so you want to invest right now. The seller knows that you don't have enough money to buy the entire gold bar, or you don't have enough money to buy the entire business. So they offer you, they share you a slice of that gold bar for you to keep, just in case the value of the gold bar goes up, just in case the value of the business goes up. In return, you give the seller money. If the value of the gold bar goes up, the value of your slice goes up. You can now sell this slice to someone else who thinks the price of the gold bar will continue to go up. You have now just made a trade, and since you will more than likely sell it at a higher price than what you got it for, you have therefore officially made a profit. So you're essentially just selling a piece of business that you own. Now, when was the stock market created? Now, the idea of people buying and selling their ownership of assets began in the ancient world, but the idea of companies letting regular folk like you and me invest began in 1602. The first company to issue stock was the Dutch East India Company. It holds the distinction of being the first company to offer equity shares of a business to the public, effectively conducting the world's first initial public offering. And we'll talk about what an IPO is later. Why was the stock market created? It was created as an easy way for business owners to fund their business or make money without having to A, take on debt, and B, without having to create a product that is harder to make or that is a riskier idea. Companies can now take the public's money and use it to grow the business. And in turn, the legal ownership, aka shares, that the public has in said company will also increase in value. I like to think of it like this. The stock market is essentially an open pool of money being exchanged back and forth. Remember, there are trillions of dollars in the stock market. It was created as a way for large money to be easily liquidated or easily/immediately put back into the bank account. For example, if you want to sell your house, it would take 30 days minimum. If you want to sell a stock, the money can be transferred to your account the next day. It's that simple. So what does the stock market look like? When people say the stock market crashed or the stock market just hit an all-time high, what exactly are they talking about? They're talking about the overall performance of the U.S. stock market. There are around 8,000 different companies who have given you the chance to invest in a business. You can access this market by going through a broker who has access to the systems, servers, and liquidity pool to allow millions of people to exchange their shares to one another. Since there are so many different companies and unique industries, they came up with a way to track the performance of each independent sector and give investors direction into what to invest in. Much like you have different aisles at Walmart, you have aisles or indexes that group together similar companies. Putting stocks in an index helps us track the performance of our favorite industries or sectors, so we don't have to search through the thousands of different companies that's on the stock market. When people say the stock market, they're talking about the performance of the big three indexes in the United States. Alright, so here's a quick explanation of the three popular indexes. So to reiterate, the word index just means a list of stocks that represent a specific part of the market. An index fund, which we'll talk about again, allows you to easily invest in all of the stocks listed in that index. The first big stock market index is the S&P 500. This index is the largest 500 U.S. public companies across all different industries. So some of the top 5 companies in the index is Apple, Microsoft, Google, Amazon, and Nvidia. The second big index is the NASDAQ 100. This is the largest 100 companies listed on the NASDAQ stock exchange. Its primary focus is tech companies. The top 5 in this index are Microsoft, Apple, Google, Amazon, and Nvidia. The third big index is the Dow Jones Industrial Average. This index tracks 30 of the largest industrial companies that we have in the United States. All of the following indexes put together gives us a representation of how the progress of the growth in the United States is going. If these indexes are doing good, investors are confident enough about the economy to invest money into a bunch of different companies, pushing the stock prices higher. Since some of these companies are in these indexes, the prices of these indexes go up also. If these indexes are doing bad, investors are not confident enough about the economy to invest money into the indexes, pushing their prices down. We'll talk about the indexes more in depth a little later.